We're a couple weeks into 2024, and after a great 2023, the stock market hasn't gotten off on a strong footing so far. That means there may be some opportunity out there. I'm going to talk about three of the biggest banks, JP Morgan Chase, Wells Fargo, and Bank of America. Go through their numbers, talk about their results, look at the trajectory of their business, and talk about valuation too, and see if we can arrive at which one of these are worth buying right now. I'm Jason Hall. This is Investing Unscripted. This video is sponsored by The Motley Fool. If you're looking for more great stock ideas, go to our special link. Go to fool.com/unscripted. Motley Fool is going to give you its 10 best stocks to buy right now. If you haven't gone to that link before, it's right on the screen. Definitely check it out after this video. What's going on with the big banks so far this year? It hasn't been a great year for the market. S&P's down just a little bit so far. JP Morgan, the biggest of the big banks, started down about 3% from its peak price. Wells Fargo and Bank of America down even more after reporting earnings and guidance that kind of fell a little bit short of expectations. Here's what we're going to do. I'm going to talk a little bit about the results for each of these banks last quarter. Also, we're going to talk a little bit about kind of the trajectory of the returns they've generated and the results, and then we'll get into valuation towards the end. I want to start things off with this, though. These are three really high-quality banks. They've all had their troubles in the past, but right now, they're very well run. They have very competent people in the CEO seat and boards of directors that are helping set the vision and the guidance for the companies. Of these three, Wells Fargo is the one that's had the most recent troubles, the fake account scandal, all of the issues that came out of that, the heavy hand of regulators preventing it from being able to grow as they work through their ugly past. Even when all of those things were going on with Wells Fargo, its loan quality was still impeccable. Bottom line is that its origination and their focus on high quality lending, low risk lending, that held up. So we don't have to worry about that with Wells Fargo like we did with Bank of America, which coming out of the financial crisis was an absolute mess for a lot of years before Brian Moynihan really got it together. And it may be the best run of all of the big banks right now, even including JP Morgan Chase, continues to be well led by Jamie Dimon, delivering great returns. We're going to start with JP Morgan Chase. I'm going to pull up its presentation from its fourth quarter results. For the purposes of this video, we're just going to focus on seeing where the trend is with these companies. And we're going to look at a couple of lines. The main one I really want to focus on their financial results is net income, $9.3 billion in reported net income, down about $3.4 billion quarter over quarter. And it's down $2.3 billion year over year from its year ago result. One thing that came into play for JP Morgan that affected all of these mega banks was a special assessment from the FDIC. I don't have it right in front of me. I'm pretty sure that was about $2.9 billion. There was that special assessment to the FDIC after we saw those three large bank failures in 2023 that were the FDIC backstop a bunch of deposits that were not FDIC insured. They can't pass along those expenses. They have to make sure it's covered, and they passed the special assessment on the biggest of the big banks to cover that cost. The biggest of the big is JP Morgan. So that's the big reason its earnings declined year over year. So I think that's an important kind of setting the standard. But it's also worth noting that we did see net interest income grow. And net interest income is basically revenue from interest, and then non-interest revenue, which is fees-based revenue. That number declined a little bit. Now, there's one other thing that's important about JP Morgan that had to do with its results. A substantial portion of its growth came from its acquisition of First Republic. I don't want to say it was gift wrapped by the FDIC, but JP Morgan was clearly the bank that the FDIC wanted to take over the assets and take on the depositors from First Republic. And that boosted its results. So probably half of its revenue growth and a pretty good portion of its income, considering the size of First Republic, came from that acquisition. Bank of America and Wells Fargo, they didn't have those same kind of acquisition-driven juiced growth that we saw with JP Morgan in the quarter. Let's take a look at Bank of America's results in the quarter. And we're going to look at revenue. This is net of interest expense. So this is total revenue, $22 billion in the third quarter. This is one that declined. It was down $2.6 billion year over year. Again, didn't have the benefit like JP Morgan did of that acquisition of First Republic that boosted its top line and drove some results to the bottom line as well. Some charge-offs and a little bit of reserve build across all of the big banks, credit reserve towards potential future losses. Again, that constant focus on borrowers' ability to continue to repay loans. They bolstered their books a little bit in that regard. And this is another one that took a large FDIC special assessment as well. But again, the numbers went backwards a little bit. Net income, $3.1 billion. That was substantially down from the fourth quarter, $7.1 billion year over year. You see a direct impact of that special assessment. It basically comes out of net income. Here's the number for Bank of America's $2.1 billion special assessment. It's 20 cents out of earnings. So earned 35 cents a share. So it would have earned 55 cents a share. You factor that back in. Again, that helps bridge the gap, but it still wouldn't have caught up to where it was year over year. What about Wells Fargo? Wells Fargo delivered pretty solid results. We saw net interest income fell year over year, fell a little bit from the third quarter. Non-interest income, the fees-based revenues actually increased from last year. We've seen some of its fee-based businesses growing, like investment banking. It's growing. So looking down to the bottom line, 86 cents a share, almost $3.5 billion in net income. It was up. How about that? Even with a special assessment, a smaller special assessment, but still actually grew its net income. I think there's something to like right there. So the interesting thing about the fact that Wells Fargo's earnings actually grew is that their loan book actually is a little bit smaller. They continue to be really disciplined, not getting caught up in trying to chase growth, staying focused on profitability, focused on managing their business really well, having high quality originations, delivering good returns for their investors, focusing on the long term. At the same time, where they're focusing on building their efforts is in their investment bank. You think about JP Morgan, Bank of America, large investment banks, the true universal banks where they have a big investment bank and a big commercial bank. Wells Fargo, it is a universal bank, but like its commercial bank been its core focus for the entirety of its existence. But more recently, it's actually started focusing on growing its investment bank. It's still a tiny size compared to its core commercial banking business. And it's certainly much smaller than the investment bank at JP Morgan or Bank of America. They're focusing on growing it. And I think it's really interesting to see. Now, let's shift over. I want to talk about returns. We're going to look at a couple of important metrics for banks: return on equity and return on assets. Return on equity, you got your equity stack of your business, your equity shareholders, and the benchmark, the goal is to deliver better than 10% return on equity over the long term. And we're looking back over a 3-year period. We can stretch it out even longer. Returns on equity have consistently been peerless of the big banks. Bank of America's results have been quite good over the past 5 years. You start stretching it further back and you see this is coming out of all of the troubles, the mortgage history from some of its acquisitions. And over the past 5 years under Brian Moynihan, how it's consistently delivered pretty solid returns. It started to dip here at the end. And I'll talk about some of the reasons why in just a minute. And then Wells Fargo, still delivering quite solid returns during the pandemic. All three had a dip. They were taking big loan loss provisions in early 2020. Came through the pandemic and you see all of the results bounce back. This is as they were taking those loss provisions and they were moving it back to the other side of the balance sheet and saying, you know what, we're fine. We're not going to take losses. We don't have to have these provisions anymore. Now you look at ROA, return on assets. So this is the entire capital stack. So this is return on all the assets that you have. So you're looking at the loans that you own, the cash that you have, the return you get on that cash, other investments that you make, securities you own, all of those assets, and then the return that you get off of all of your asset base. And 1% is the target number here. And the two things that jump off the page again, JP Morgan, consistently peerless with really high ROA. And interestingly enough, Bank of America return on assets has dipped below 1% here recently, while Wells Fargo's ROA has retracted back above 1% after some cyclicality. During the pandemic, same thing, the impact of those loan loss provisions and then putting them back on the books afterwards when it became apparent because of all the stimulus that there was no real concern. But you've seen lower returns start to happen. Okay, what's going on? Why are returns dipping here? The FDIC gives us some really good information that we can use to take a closer look. We're just going to look at three things. We're going to look at cost of capital. We're going to look at the yields that they generate on earning assets. And then we're going to look at the net interest margin, which is basically the profit margin they make. We're going to start with JP Morgan. That's right on the FDIC's website. This is from the third quarter. We don't have the latest information for the fourth quarter yet. It will be coming in soon. It'll move a little bit, but directionally, this is really useful. Yield on earning assets, 4.96%. So what that's basically saying is you take all the cash, all of the loans, debt on credit cards, mortgage, you put them all together, and the average yield on those earning assets, 4.96%. It's not bad. One of the things that these big mega banks have in spades is low cost of capital. Cost of funding earning assets, 1.85%. That's basically the yield that they pay to depositors and checking and savings and CDs and other avenues they have to borrow money for, like interbank lending, Federal Home Loan Bank, things like that, ways that they can get capital. This is what they pay. Their average interest yield is about 1.85%. That's very low. This is a very attractive number. The result, you take the yield on earning assets minus the cost, net interest margin, 3.11%. That's their spread, right? That's what they get to keep. It's 3.11%. That's pretty good. Now let's take a look at that same number for Bank of America, 2.76%. Let's take a look at the number for Wells Fargo, 3.61%. So what? 3.61%. Wells Fargo definitely a cut above here. And it should be. This is their core business. Lending that's their thing they're really good at. That's their strong suit. JP Morgan does a substantial amount of investment banking in addition to commercial banking. 3.11%, pretty good. Now, Bank of America, 2.76% net interest margin. I'm going to bring this slide back up. And I think this helps explain part of why ROA for Bank of America has dipped recently. It has a massive amount of low interest yielding loans and investments on its portfolio, a lot of which were written in mid 2020 through 2021 when interest rates were ultra cheap. Those are weighing on its bottom line. Now, they're bolstered by that super low interest rate deposit base that they have. The concern I have, interest rates have moved up so much. There's a lot of calls that maybe the Fed's going to start cutting rates, maybe multiple times this year. I'm less convinced that's going to happen. And I think these big banks are more at risk of having deposits start to leave. Let's talk about valuation. We'll start with price to earnings between 9.7 and 10.3 times earnings, with JP Morgan actually right in the middle, 10.3 times trailing earnings. Now, obviously, 2024 is going to be a different year than 2023. Probably going to see a pretty stable year for the big banks, as I would guess. Maybe a little bit of a decline depending on what happens with mortgage activity. Definitely higher interest rate environment than we saw a couple of years ago. But my concern is we're going to see more pressure on their deposit bases this year. So sure, they might see loan activity pick up. Maybe more depositors are going to leave for higher yields other places. That means they're going to have to find capital that's more expensive, or they're going to have to increase yields they're paying to depositors. So I don't necessarily know that we're going to see better economic returns on the loans that they write this year than we saw last year, because a lot of those earning assets, they're earning what they earned last year, and their cost of capital is going to move up, right, as they have to pay higher interest yields to depositors. So I think that's one thing to consider. They're also close in this valuation metric. There's not a clear leader of the pack. I want to look at price to book value. This is really useful for banks. This story starts to shift a little bit. Bank of America at 95% of book value, actually a discount to book value. And then JP Morgan's actually above 1.6 times book value, which is a very rich valuation. Now, you might see this very high book value and say, from an earnings basis, their assets obviously are generating superior earnings. If the book value at 1.6x on a similar price to earnings ratio, that's true. And the quality of their loan book, higher net interest margin than Bank of America, that's why to a certain degree it has certainly earned a higher premium there. Now, the question is going to be, with volatility in investment banking, potential headwinds for net interest income for JP Morgan Chase, does this premium to its book value start to be a headwind? And I think maybe that's the case. Now, 95% of book value, Bank of America at a discount to book value. Historically, you buy it at a discount to book value, you did really well. But again, the quality of its loan book is more of a question. Lower yield, lower net interest margins, has a big advantage in terms of its cost of capital, but its deposit yields. But I think that's going to be a headwind this year. I think they're going to have to pay more and more out. 1 times book value, 10 times earnings. The one we haven't talked about so far, Wells Fargo, I think, is a great balance of generating great returns. They've demonstrated their ability to excel when it comes to their lending business and get better margins than these other big banks do. They're just really good at lending. It's been their primary focus. At the same time, I feel like their investments that they've made in investment banking, while it is a risk, running an investment bank is very different than running a commercial bank. I think the timing is really good because the cycle, I think, is going to start to get better for investment banking. I think those investments, it's still really small, but I think they could really pay off over the long term for investors. and they've continued to prioritize making small incremental investments to grow that part of their business over time, not go out and try and find somebody, not that they necessarily could even do it anymore with the regulatory environment, but they haven't tried to buy their way into investment banking. They're just trying to build their own investment bank, which I think is a really smart approach to take. So there you go. I think it's pretty clear at this point. Looking at these three banks, if I was going to buy one right now, I'd probably be putting my money on Wells Fargo. I think you probably do fine with Bank of America as well, and maybe over the long term, JP Morgan too. Even though that book value does worry me a little bit, I think it's such a high quality business and it makes money in so many different ways. Probably do okay, but I think of these three, if you're looking for real outperformance and you're looking for one that's going to deliver the best returns over the long term, I think Wells Fargo right now is the big bank that I would be buying.